Welcome. Good afternoon, everyone, and thank you for joining us. You are attending the DBRS Morningstar Frontline's Market Perspective webinar on CPACE. My name is Stephanie Ma. I'm a researcher in our Structured Finance group, and today I have the pleasure of being joined by my colleague Ed Dittmer, an SVP in our Real Estate Adjacent Assets group and the lead analyst for single asset CPACE securitizations. Before we get started, a couple housekeeping items. Please feel free to type in any questions that you may have throughout the presentation. You should see a text box on the bottom of your panel. You can click on that and type in your questions. We will address your questions at the end of the webinar. Now let's get this webinar started. Fixed income in general has had a challenging year against the backdrop of rising interest rates, inflationary pressures, and risk of recession. Nonetheless, the U.S. economy has displayed a remarkable resiliency for the first 9 months of this year, with job growth continuing, GDP keeping pace, and inflation moderating. At last week's meeting, not unexpectedly, the Fed chose to keep rates unchanged, with one additional rate hike at best expected at the end of the meeting for this year. As you can imagine, traditional CRE lenders have become more cautious and have further tightened their credit standards in response. Newly added into this mix, throw in the UAW strike, the resumption of student loan payments next month, and escalating oil prices. In the broader ESG world, however, while politically some have weaponized the term, we are seeing states become much more proactive about combating climate change concerns. For example, a couple weeks ago, the California State Assembly passed 2 sweeping bills addressing climate change, one that requires companies that do business in California to disclose their greenhouse gas emissions, and a second that would require companies to report annually on their climate-related financial risk. Such initiatives can only be a positive for PACE, as property owners increasingly become more cognizant of their greenhouse gas emissions footprint and the need to adhere to upcoming mandates. And the perfect example is right here in New York City, the Climate Mobilization Act, which was passed in 2019, a landmark package of legislation and one of the most ambitious measures taken by a major metropolitan city to date to reduce greenhouse gas emissions, to reduce them by 40% by 2030 and by 80% by 2050. With this backdrop in mind, the PACE market has continued to thrive in 2023. We have seen legislative advances as well as an increase in originations, particularly for larger sized projects. On the legislative front, there have been a number of CPACE program updates across Georgia, New Mexico, New Jersey, Alaska, Massachusetts, and Nevada that either make it easier to implement CPACE or expand use cases to include things like resiliency and new construction. Meanwhile, Michigan, New Hampshire, Colorado, and Indiana have each passed PACE enabling legislation this year. According to PACE Nation, cumulative CPACE investments crossed the 6.3 billion mark this year, with 1.1 billion in the first 8 months alone, and a full year total of 2 billion expected when the year closes. As I mentioned earlier, we're seeing larger sized originations, with the average size in 2023 being 13.7 million versus the 8.5 million seen in 2022. However, it's worth noting that the largest sized CPACE origination to date occurred this year, totaling 230 million. While the majority of CPACE projects are dedicated to energy and water efficiency efforts, we are increasingly seeing resiliency-related enhancements being made. For example, improvements to properties to fortify against earthquakes, fires, tornadoes, and hurricanes. In terms of property types, across these larger sized projects sized at 10 million and above, not surprisingly, hospitality accounts for the bulk of these financings, representing roughly 30%, followed by multifamily at 23, office at 15, and healthcare at 14. In an effort to keep investors more apprised of credit trends during these uncertain economic times, we launched our inaugural PACE snapshot just a few months ago, which you should see referenced in a link on the bottom of your screen. This new semi-annual research series is dedicated to providing insights on general industry developments, as well as collateral performance trends underlying our publicly rated PACE transactions. Admittedly, for the time being, the bulk of that analysis is concentrated on the resi side. However, as we rate additional CPACE transactions, the aim is to expand that snapshot to include more in-depth analysis on the commercial side. Now, earlier we referenced CPACE origination stats. On this slide, we can see that securitization volume reached roughly 667 million through the end of this month. Not surprisingly, with overall fixed income bond issuance down for 2023, PACE has similarly seen a reduction as well, compared with the nearly 1.6 billion in securitization issuance in all of 2022. However, the robust pipeline that we spoke about earlier of PACE assessment originations, that bodes well for the future ABS and CMBS, with more pools being available to potentially securitize. I'm so excited for you all. As I mentioned earlier, we have Ed Dittmer joining us today. Not only is Ed our lead single asset CPACE analyst, but he is also a walking encyclopedia for anything CRE related, a traditional kick the tires kind of guy. Thanks for joining us, Ed, today. But before we get into the thick of things, I thought it might be helpful for us to take kind of this step back first and briefly discuss what exactly CPACE is in a nutshell.
Sure, and thanks for having me, Stephanie. CPACE, which stands for Commercial Property Assessed Clean Energy, it's a type of financing geared towards energy improvements, energy efficiency, resiliency, and renewable energy. However, unlike a traditional mortgage, the CPACE loan, or assessment as it's often called, is tied to the property similar to a tax assessment, and it's actually repaid through your property tax bill. So even if a building gets sold or transferred in any way, the assessment transfers with the property and becomes a liability of the new owner. The assessment itself doesn't accelerate in the event of delinquency either. Right now, over 30 states have an active CPACE program with slightly different criteria, but the general idea is the same. Now, there's a long list of items that would be considered standard CapEx on a building that's covered and eligible to be financed under CPACE. If a building needs efficiency upgrades, which could include HVAC, boilers and chillers, lighting, and windows, all of those types of items are eligible. And some states allow financing on projects that are already constructed, given that they meet the criteria, and some will allow financing to be used on new construction projects. And some of these states have different rules as to what might be eligible. California, for instance, allows earthquake resiliency measures, while Florida allows storm resiliency as part of CPACE financing. Now, because the assessment is tied to the property through the property tax, it becomes a senior lien on the property effectively, and it sits at the top of the payment priority. So as a rating agency, we analyze CPACE deals as part of our standalone SASB transactions and our pooled CPACE transactions. SASB is what my team primarily deals with, and that's what we'll talk about here today.
And I think I just want to follow up on that point, Ed, that you mentioned that, the PACE assessment cannot be accelerated, meaning that the loan cannot be called in the event of a default. And that's an important distinction for PACE. Only the amount of the past due assessments would be due at the time of a foreclosure. The future assessments remain due and payable in the future, and the property remains encumbered by the CPACE assessment during the remaining term. But let's get back to your last sentence, where you mentioned both pooled and single asset CPACE transaction, which tees up this next question perfectly. Identify for us what single asset CPACE deals are.
Sure. So a lot of transactions traditionally were a pool of a number of loans that would go in and be securitized as a single bond. But you can actually have a single loan that a lender and issuer makes and have that single loan rated. Now, because it's a single loan and the risk to the property is idiosyncratic, there is a slightly different approach to developing the rating.
And before we discuss DBRS Morningstar's rating approach, I think it would be helpful to hear your thoughts on why some loans are getting rated in pools while others are getting rated solely on their own.
Sure, there's a couple of reasons for that, Stephanie. One is that the CPACE model for pooled transactions relies on diversity as one of its key ratings drivers. As you get larger loans, you can increase the concentration in the model, and that actually can have a negative impact on the final rating. Some issuers may have multiple pools and are able to include different participations of the same loan across those pools to reduce the concentration, keep it low. But what we've started to see is that the size of loans is getting larger, and even those participations aren't sufficient to maintain the pool diversity. So rating a single loan becomes an option. Another reason is that some issuers just don't have a rated pool outstanding yet, but they'll still need a rating, so the single asset, single borrower rating becomes their best option.
And one of the trends that we highlighted earlier is seeing this increasingly larger assessments taking place in terms of dollar volume. Ed, would love for you to share your insights on what you think is behind driving this new trend.
Yeah, Stephanie, with the disruption in the capital markets that we've all seen, CPACE has become an increasingly attractive tool for property owners and developers. Right now, a construction loan could get priced at up to SOFR plus 600 basis points for a high leverage deal. But if you can secure CPACE financing for at least a portion of the capital stack, you can reduce that cost of capital. Now, there are also cases, given that the tightening that we've had in the credit markets for first mortgages, CPACE is becoming a potential option for rescue capital for refinancing. So cases where private equity investors or second lien lenders might be able to extract some fairly draconian terms from borrowers, CPACE is emerging and as being explored to fill that gap. Larger property owners are starting to see value in CPACE, and they're coming to the market with more financing requests. So we're increasingly seeing deals that are over $100 million and at a higher percentage of cap stack, sometimes more than 30% LTV.
And how does DBRS Morningstar's credit rating approach differ when we look at these single asset CPACE transactions versus, say, the rated the pool deals that we rate?
Yeah, so the single asset, single borrower approach is a real estate methodology, and it comes actually out of the CMBS team rather than being a more cash flow based methodology. And because of the single property risk, the approach is more real estate centric and focuses on the performance of the property and the loan to value ratio. At its heart, SASB is a liquidation methodology. It measures the DBRS property value against the outstanding debt to determine a recovery for the investors if the asset had to be sold to repay the bonds. Our methodology spells out various LTV thresholds, and we compute the maximum rated proceeds allowable at any given rating category. On the surface, it does seem a little bit harsh to assume liquidation, but single property risk ultimately requires credit enhancement that may be a little bit more onerous than a deal with lots of diverse assets in it.
Now, keeping that in mind, I mean, not surprisingly, property values have become much more of a focal point this year. So Ed, how do we determine property values?
So Stephanie, with already constructed and already leased assets, the approach is pretty straightforward for us. We look at the in-place leases at the property, we compute the revenue from that, we make some adjustments based on our methodology, and then we get a net cash flow and apply a cap rate to the DBRS net cash flow that we've generated. That cap rate is often going to be 150 to 250 basis points higher than an appraisal cap rate. This elevated cap rate is something we often get asked about when we provide feedback to issuers. Some of the rationale for that increase has played out over the last year, where we've actually seen cap rates increase very significantly. Because our analysis takes place at a single point in time, we leave a little bit of room in the analysis to account for those increases, and so that we can exhibit potentially less ratings volatility over time.
Now, recently, New York City legislation was amended to permit CPACE to be used for new construction projects. It's worth noting that in other jurisdictions as well, legislation either needs to explicitly allow PACE to be used for new construction projects, or the legislation needs to be broad enough so that it's not excluded by any provisions. Ed, what are we seeing on this new construction side?
Yeah, Stephanie, I would say that this is probably one of the largest increases in volume of inquiries over the past few months. Obviously, construction is a different animal because now you add in an element of construction risk, leasing risk, and market risk before the property is delivered. So with construction, obviously, we're not going to have leases in place in most cases, and we don't have historical performance of a property to rely on. We do have borrower projections, appraisals, market information, and we have our own internal database of loans that have been reviewed by the CMBS team. Our goal is to formulate a cash flow that we think can be sustainable throughout the course of the financing. So it doesn't just take the year one cash flows, and it doesn't take the final stabilized projections as the baseline. Instead, what we do is we take a deep dive into the property and the market, try to use all of the information that we have, and we'll run our analysis to develop a net cash flow that we see as sustainable, defensible, and consistent with our property cash flow methodology. Now that, of course, may be lower than an issuer's underwritten cash flow. Once we develop that cash flow, we apply our cap rate to derive a value that we think is achievable and sustainable. Now, of course, that value is likely to be below what an appraiser projects as a stabilized value based on our cap rate approach and the lower cash flow that is likely to be in place. Once we get that value, we can apply certain positive or negative adjustments. We have several qualitative adjustments in our approach that gives additional credit or actually can penalize the loan based on three factors: cash flow volatility, property quality, and market fundamentals. So we'll review each of those and either give credit or assign a penalty to the loan. Now, DBRS Morningstar expects C-PACE transactions to also include mitigating features similar to SASB transactions. And these include servicer advancing, reserves, liquidity facilities, or other transaction features to offset the risk that note holders do not receive timely payment of interest or ultimate recovery of principal from the underlying collateral. The rating in that case may be limited or affected by that lack of structural features and may involve a cap on the final rating.
And what about property types, Ed? I would imagine that a lot of folks on the webinar are interested in seeing, or hearing more about which types of properties that we're seeing that C-PACE assessments have attached to them.
Yes, Stephanie, we see all the major food groups: multifamily, office, retail, industrial. Lately, we've actually been fielding a lot of inquiries on hotels, and more specifically, hotel construction.
Indeed. During the pandemic, there was a lot of concern about the viability of hotels. I'm curious to hear more about hotels and any insights that you can share.
Sure. Again, you have a very tough financing market right now, just across the board on all property types. And interestingly, hotels had a pretty nice run during and immediately after the COVID shutdowns as people visited resorts, especially in those drive-to locations as opposed to fly-to locations. So while we haven't seen as strong of a recovery, say, in CBD hotels that cater to business travel, the leisure segment performed exceptionally well, and actually a performance in some cases that was better than pre-COVID. So it's a combination of strong recent performance and a challenging capital market landscape, especially for new construction right now.
I think that was the big surprise for everyone during COVID. A lot of concern over hotels, and they ended up coming out pretty well post-pandemic. But what about on the more kind of the esoteric types of assets? Can you share what you'd be seeing on that side of the fence?
Yeah, esoteric assets are something that we've seen, and we will quote on those. I can't discuss specifics because a lot of these deals are private or those that we're still looking at. But there's a wide range of non-standard properties that we get inquiries about. A lot of these properties are going to be operating assets, which outside of hotels and skilled nursing can really present us with some challenges in SASB analysis. As I've said before, the SASB methodology is a liquidation methodology. So in our view, the property has to have a universe of buyers for that type of asset, or it has to have an alternative use. With a standard property type, I know that if a hotel defaults, there are buyers who will come in, take that property over at some discounted price, and then continue to operate it. I can't be assured about the possibilities for something like a diesel fuel depot or a boat storage and maintenance facility because they're just so specialized and there really aren't market rents for that type of asset. And if the asset, of course, fails, what is the ultimate liquidation scenario for that? But again, we will look at these, and what we'll try and do is determine what an alternative use might be for the property and will compute market rents on that basis. So one of the things we may do on esoteric assets is we could include a pretty heavy CapEx load to account for the releasing costs or any construction that might be necessary. So far, my experience in this field is that the value that we come up with tends to be pretty depressed from what you would see in an appraisal, and sometimes that will limit the potential of that sector in the market for now.
We've condensed a lot of information for folks about our approach to single asset CPACE. And Ed, I think as we close, a fitting question that most investors would probably like to hear about is, what do we expect to see going forward in CPACE?
Yeah, we definitely think that the trend of increasing loan-to-value ratios for the CPACE alone is going to continue, and I think we'll continue to see loan size move higher. Right now, everybody is looking for debt, and this has become a very reliable source at a competitive rate where it's allowed. More states and cities are enabling CPACE, so it's just going to be available in more areas in the coming months and years. Now, anecdotally, we do get a lot of calls from different lenders that are considering a move into the business. They're trying to learn more about it and how they can get comfortable with the debt. There's still a lot of education that we're doing across the board, but I would expect to see a larger universe of lenders in the market as we move forward.
Yeah, I think that education part is kind of like that learning curve. It's just getting not only property owners, but also legislators, more familiar with PACE and the benefits that can be reaped through this additional kind of financing tool. This concludes our prepared remarks for the webinar. Now we will open the discussion for Q&A. Again, you should see a text box on the bottom of your panel, which you can click on, type out your question. Let me just check our board over here. I think I saw a couple come through. Just bear with me. Okay. Has DBRS Morningstar rated first mortgages with CPACE attached? That's a fair question. Yeah.
Yeah, that's a really good question. It's one we hear a lot. There have been a handful of transactions where a loan had existing CPACE financing or where the borrower was permitted to obtain CPACE. But for the most part, the CPACE involved was very small. In most cases, less than 5% of the total capitalization. But right now, I think it's because all the rating agencies are still trying to get their arms around this type of financing and how CPACE ultimately affects the first mortgage that is keeping a lot of first mortgage lenders out of the CPACE space. I think that we as an agency have become much more comfortable with CPACE, but ultimately the payments do take cash out of the borrower structure, and financing right now is tight. So there isn't a lot of room for leakage in the cash flows. With that said, I don't see any reason that a well-structured deal where the rights of all the lenders are protected can't be rated. There are proposals where traditional first mortgage lenders are looking at executing both the first and the CPACE. We haven't seen one yet, but we do get a lot of calls about those.
Let me just check our board here. I see one or two others coming in. Okay. What about on the office side? Are you seeing an increase in properties utilizing CPACE as part of the capital stack?
We have. There have been a few inquiries this year, and we did actually close one transaction backed by an office property. As with everybody in this space, we are certainly being more cautious than we were just a few years ago, but I would personally never say that a deal can't be done in a certain sector. Everything just depends on the deal structure and the collateral. Now, because more large loan CPACE transactions are going to involve construction, I think CPACE activity in the office sector is going to be pretty soft, since the construction financing might be very challenging to obtain right now. And frankly, developers themselves are going to be reluctant to pull the trigger on starting construction right now.
Just check. I think we have one or two more. Hold on. Let's see. Oh, someone's asking, will the slides from the presentation be made available? Absolutely. You'll get actually an email from Business Development, which will say that the replay is available, and then you can also view them on Bright Talk's platform as well. So when you do the webinar playback, all of the slides will be made available. Okay, I think
there's a couple of questions here, Stephanie. Maybe I'll read it out here. One is how common are single asset structures where the entire C-PACE financing is securitized? For us, for the most part, when we're doing a single asset transaction, the entire C-PACE is getting securitized. So what we can do is we provide a potential capital stack to an issuer. And I know that a key rating for a lot of issuers is to get to a single A. But even if some size is beneath that, we can actually still provide the rating on the portions of the financing that size beneath the single A and even into the non-IG category. So we're generally seeing the entire C-PACE get rated. But again, the first mortgage is something that is happening in more limited cases. One person asked, do you see FHFA approving C-PACE anytime soon? Truthfully, your guess is probably as good as mine. Again, that there's a real education process that has to take place. You speak to people in the business, and I was on a call not too long ago with people talking about storm resiliency and insurance costs, and frankly, a couple of people on that call didn't even know what C-PACE was. So that's an opportunity for us as a rating agency to do research to show the market about what these are, and of course for issuers to go out and educate the public and various policymakers on what C-PACE is and how it might benefit their lending group. So not something that is probably on the cards today, but long term, I think it'll probably happen once that education process works itself out. Another question that came in have you ever evaluated a C-PACE with a ground lease? That's another good question. We have seen C-PACE deals that have had partial ground leases on them, but we're still trying to get our arms around when you have a ground lease and the C-PACE will follow that land, what happens in a situation where you get a default on the ground lease. That's something that I think once we see a deal, we can't tell you as a rating agency how to structure something. Once we see a deal, we can have our legal team review it and determine whether or not everybody's interests are protected, and of course the bondholders as well, and see if there's something to be done there. But we certainly have not closed a deal with a ground lease attached.
I think there's one more, Ed, right? I think one more.
Okay, go ahead.
What asset classes do you consider to be more stable than others based on the current market environment?
That's a really good question. I think that the market and we as a whole still generally view multifamily as probably the most stable asset class. The way I put it to some people is that with office and retail and even industrial, the risk there is often dependent on event risk. You lose a large tenant, your cash flow can go from 100% to 0% pretty quickly. With multifamily, there's always an option that if you start to see softness in rents, you can lower rents a little bit. If you start to see people move out, you can lower rents even more. There is a point where you can lower rents and fill the building, as they would say. And so that at least allows multifamily to preserve some value over time, even if the cash flow isn't what you initially projected, it might still have something. Whereas what we've seen in office is if you lose a major tenant, you could see a pretty steep drop in value. Retail has been through that, less so with more anchored, but certainly more so with regional malls where you've seen very, very high loss severities. And industrial, when you have single tenant properties, I think that it's a very stable asset class. I don't expect a lot of vacancy to occur. But again, when you're dealing with event risk, you can see industrial properties go quickly, have their cash flow go quickly south. But industrial is a great property type. We just don't see a lot of it in this space, and I think that from what we're seeing, multifamily is a nice thing to own. Hotels, again, we don't dislike hotels. We certainly have done our fair share of them. I don't think that hotels are inherently unstable, but we are entering a market now where we've come out of COVID. Hotels have done very, very well. Now you've got an environment where instead of going domestically, some people are going overseas, and that's softening some of the hotel markets that relied on that travel. And then, of course, as we see interest rates rise, people have less disposable income. Are they going to be spending that income on hotels? Fortunately, hotels right now are still doing reasonably well, but you are seeing some sectors of that space that are starting to underperform. Some of those hotels I mentioned earlier that are dependent on business travel, we still haven't seen that come back yet, and those hotels may not cater to the leisure travelers quite as well.
Just filtering this, I think there's quite a few to make sure that we're not missing any. Here's one I think that, let's see, can you speak more about the servicer advances and or reserves that may be required for SASB deals? Are these required on all SASB transactions?
So in CMBS SASB land, we're rating to timely interest and ultimate repayment of principal. And one of the features that allows us to do that is the fact that there are servicer advances and liquidity facilities that can provide cash flow to the investors when you see the defaults and delinquencies come up. There are other structural features that we look for, and what I generally do is, again, I can't tell you that I require something. I expect certain things, but we have a legal template that we put into our SASB loans, and I haven't seen a deal come through with servicer advancing on the CPACE side, but we make that template available to different market participants to take a look at the things that we consider to be credit neutral from a legal and structural standpoint, and our hope is that over time that CPACE loans start to converge a little bit more to that legal template.
Here's one. Can senior assisted and or memory care living facilities be rated with the single asset methodology?
They can. We have done both skilled nursing and senior housing type properties on the CMBS side. So we're able to rate those and we're able to look at them. A lot of it comes down to the way we'll look at the view on this is it a private pay facility? Are there Medicaid or Medicare reimbursements? What the patient census might look like if there is some of that Medicare and Medicaid pay. So we'll consider a lot of those different factors. We certainly have seen some skilled nursing on the pool side. I don't see any reason why we couldn't do it on the SASB side. Some of those loans may be a little bit smaller than what you might want to get rated on the single asset side, but again, I wouldn't have any barrier to looking at one of those right now.
We still have a handful. Thank you for being such an engaging audience. Let's see. What are the typical exit routes for these CPACE loans? Refi with a new CPACE loan, perhaps?
That is, I guess, yet to be determined because a lot of the CPACE loans that we're rating are 25 to 30 years. So we haven't actually seen one have to get refinanced. We've had the odd deal where you've had some different components of the collateral that were backed by CPACE, and some of those components might often get sold off or released as part of the business plan. And in some of those cases, the CPACE will get paid down as those components are sold off. But again, they'll get refinanced by another lender down the road. So we really haven't seen, as far as I know, a CPACE loan have to get refied because it, and really you wouldn't because they tend to pay down and fully amortize. So there wouldn't really be a need to exit on a CPACE loan. I think it would just be letting that loan run its course, letting it pay down, and then putting a new one in place if that property meets the qualifications and the criteria.
I think we probably have time for another question. Let's see, how does the audit work in terms of ensuring the borrower is building eligible components to the property?
That's a good question, and it is going to depend upon the state. Some states and some municipalities are going to be more strict about it and require more certifications around that type of thing. Other states are a little bit more, I would say, a little bit more loose with the requirements. So it really depends on which municipality and which state you're in. The other part is as part of the financing, where it's required, we will generally see some certification that those expenses have met the PACE eligible criteria. So it's done by the lender, by a third party that certifies this information that goes back to the PACE authority in the state. But again, it's just going to depend on where the PACE loan originates.
I think, did I miss any, Ed? Let me see.
There's one question here. When do you anticipate CPACE spreads to come in and price similar to AA and AAA CMBS, considering its lien priority in the capital structure? I'm going to hesitate to forecast where spreads in the market are going to go. I think if I got in that business a couple of years ago, I would probably be out of business right about now. I think the spreads on CPACE, just like with anything else, will be a function of investor interest in the asset class. And the more investors that you have, the more interest that you have, the pricing will ultimately improve. But there's always going to be a subset of investors that look at this as just, let's say, straight additional debt. And some of those investors may be leery of CPACE. Again, education will close some of that gap, but I don't know that you'll ever get to the point where it completely closes.
Here's one that we get often. Do you think senior mortgage lenders are hesitant to lend on properties with CPACE financing given the first lien nature of CPACE?
I guess I would say I think that the hesitance around CPACE on the part of a lot of first mortgage lenders is understanding where CPACE comes in the capital stack. On one hand, you do have cash going out of that ecosystem, but on the other hand, there isn't an acceleration that as a first mortgage lender that you'll be, let's say, significantly crippled or distressed by a CPACE loan. And I think that over time, a lot of first mortgage lenders are going to continue to look at this as something that doesn't completely prime their mortgage. One of the big things I've talked about with some potential lenders that have just asked me casually about it is, as a first mortgage lender, you want to make sure that you're working with the CPACE lender or talking to the CPACE lender to make sure everybody's rights are protected throughout the stack. I know that a first mortgage lender certainly doesn't want to give up some of their rights and remedies, and they want to make sure that the CPACE lender hasn't exceeded any of those bounds. So some of that will have to take place on the legal side with an understanding between lenders of both sorts, and an understanding by first mortgage lenders that really, if you have a delinquency on the CPACE side, it doesn't automatically create a huge loss for you as a first mortgage lender, although that you're going to have that ongoing responsibility if you foreclose to make the PACE payments and then ultimately liquidate that property and sell it to somebody who will then assume the PACE payments from you.
I think that we have addressed all the questions posed. If you all come up with questions afterwards, you can see both my contact details as well as Ed's on the slide. we welcome any questions you may have later on. But we want to thank each and every one of you for not only being such an engaging audience. I think this is probably the most questions that we had on a live webinar. But we want to thank you for taking time out of your day to spend it with us. Special thanks to Ed for joining us and sharing his invaluable insights on the CPACE sector. This webinar is being recorded and will be available for playback should you wish to revisit any discussion points or perhaps share the replay with your colleagues. For those of you that are attending IMN's upcoming ABS East in Miami, we look forward to seeing you all in person next month, where we will share additional insights about PACE on the 2:45 p.m. panel on Tuesday. Thank you again for joining us, and enjoy the rest of your afternoon.
Thank you, sir.